Welcome, friends. Today's topic is systematic approach to building an empire from scratch. So I'm super excited because we cracked the code for what the successful investors have that you and I may not have. Why are they making 100 times more money than you and I combined, but yet they still have the same number of hours a day that you and I? So what is it that they have and how do they do it? Okay, because you need to know the secrets so that we level the playing field, right, with them, and we start taking these awesome deals home as they are doing today. Okay, so let me tell you, out of 100 investors, about 95% don't really make it to where they should. It doesn't mean that they fail, but they just don't make it to the level they should. Okay, only 3 to 5% of real estate investors are truly successful. And I'm going to tell you why. Why is that? You might wonder why is that? Well, there are many roadblocks in real estate. So I'm going to quickly show you all the roadblocks that you and I face on a daily basis once we decided to get into real estate. So we're going to start by not knowing where to invest. Okay, so identifying hot markets. Many investors, including myself, when we started, we invested in the wrong markets, either in a really distressed market where neighbors think that your car is theirs, that your safety is a risk, obviously, and then another market where we did not understand the numbers, we overpaid for the property, we went over budget, we could not sell the property, and today it doesn't cash flow. Okay, not understanding the markets. Next, identifying great deals, right? I mean, what's a great deal? How do you define what makes a property a great deal? What makes a property a home run deal? Who knows, right? That's a big question mark for most investors. But don't worry, because today I'm going to give you the secrets that you won't even need a calculator, a piece of paper, nothing. You're going to be able to identify an amazing deal in seconds. Next, analyzing, right? Have you heard of the phrase that people say analysis paralysis? When people spend like 30, 40 minutes, even over an hour analyzing, trying to figure something out, there's something 100% wrong with that approach. Okay, so they say analysis paralysis because guess what? At the end of the day, you end up doing nothing. You freeze because you don't know how to do it, whether it's going to make sense or not. You have no idea. So we're going to knock that off. Next, you can take the first exit on your real estate career, and that's the quickest, right? So you decide to do wholesaling, meaning that you get a property in the contract, you don't want to buy it, fix it, or rent it. You just want to sell the contract off to another investor or cash buyer, right? Next, if you decide to take the next two exits, either the flip or the hold, you have to pay for the property, right? So you need to get funding. So that's a big piece of the puzzle, right? That most investors have not figured out, right? And that's a deal breaker. In fact, all of these are deal breakers, but these are some of the main deal breakers. Next, doing the rehab, right? So that could be a big deal because guess what? Contractors are the biggest headache that all investors face. Let's face it, even the bad ones right now, they're super busy, right? You cannot get even a hold of them, and they do really poor quality work. So it's like, oh my goodness, a big headache doing the rehab, right? And then flipping the property, that's even a super risky approach. Why? Because guess what? You need to put the property on the market at the right time, meaning early spring, summer. If you put it in the winter, guess what? It's gonna sit there for a long time, right? And then not only that, but if you sell it, if you try to sell it for a high price, guess what? It may sit on the market even longer, right? So pricing the property, it's also a big concern, and doing the right marketing. So if you're not working with the right broker, guess what? Your property can sit in the market for months and months. Next, buy and hold, right? So that's also a big challenge, not finding the right tenants. when you get a really bad tenant, it's one of the worst nightmares. The first rental that we tried to do, guess what? We brought in the worst tenant. They did not even pay a single penny for rent. Just to make the story short, we had to do an eviction. Okay, so it was such a big headache, not screening tenants appropriately. Okay, so what we're going to do today is I'm going to tell you the secret of what the pros have. They have three things, okay, in common. And I'm going to use the board because you really need to understand these. They have, number one, they have a great deal. Number two, they understand basic analysis. And number three, they have funding. Well, guess what? They have funding because they have a great deal. So what I'm going to do is I'm going to write this down because you need to understand. So I'm going to put number one. So they have a great deal. Number two, they understand basic analysis. And number three, they have funding, okay? But guess what? They have funding because they have a great deal, okay? So if you think about it, we need to know how to find great deals and how to do quick analysis, okay? But guess what? I can spend like 2 hours on each. So what we did is we cracked the code, and I'm gonna tell you the secret of how you can find great deals and analyze them in seconds, okay? Because there's a lot of numbers and formulas that go behind the board, okay? There's a lot of them, but we're gonna keep it very simple. So again, top investors, they have a great deal, they understand basic analysis, and they have funding, but they have funding because they have a great deal. So what I'm going to do now is I'm going to focus on the first two, finding a great deal and analyzing. Because guess what? If you get these two right, that's it. If you can find a great deal and if you can analyze the deal effectively and efficiently, guess what? You got it made. Because when you have a great deal, guess what? There are going to be so many investors even wanting to partner up with you and give you the money, right? Because there's such a shortage of great deals right now, especially because of the pandemic, right? So if you have a great deal, it's like, think about this. You have the golden goose, right? So everyone is going to want to do business and partner up with you. So what we're going to do is we're going to focus on finding great deals. So I'm going to erase the board. Finding a great deal. What makes a property a great deal, right? How am I going to make a lot of money when I find a great deal? So very, very simple. Okay. First of all, I'm going to give you the secrets. Number one, a great deal is a property that you're going to be making money the minute you get it on the contract. Not when you flip it, not when you rent it, which means that you have to have at least, once you've done all the repairs, 25% equity, okay? That's the formula. So what does that mean? If you buy the property for 100,000, okay, and then you're gonna put in 40, 50,000, property should appraise for at least 200,000. So you have only purchase plus rehab 150, and the property appraises for 200. So you have 25% equity. Okay, so now the question is, how do you find that? How do you know that? Okay, if it's a great deal, because you can see so many properties in many areas. How do you know it's a great deal? And most importantly, how do you know how much to pay for the property? So when we get into the analysis, you need to get three numbers down. But I'm going to explain that further. You need to know the ARV, the rehab, and you need to know how much to pay for the property. But guess what? I'm going to simplify all that, but I'm going to focus on finding great deals. So I'm going to make it super, super simple. This is the formula and the secret for finding great deals, okay? So when you are looking for properties in any market, there are four types of market, right? So you have A, B, C, and D. So A being the most expensive, B is the bread and butter, C is a little bit more challenging, and D, it's a distressed neighborhood. So we're gonna eliminate A and D's, right? We don't wanna get into a market that is extremely expensive because the numbers are not gonna work. You don't wanna get into the D areas where your safety is at risk, right? So I'm gonna eliminate that. So we're gonna focus on bread and butter areas and challenging areas, okay? Now, the next question is, when you look at a property, how do you know it's a great deal? How much should you pay for the property? First of all, the secret is focus on properties. This is to find a great deal that are less than 200,000. That's secret number one. Please don't buy properties over 200,000 because this is going to maximize your return and minimize your risk. This is how you're going to be making money. Not only that, you're going to be able to do more deals a year. You're going to be maximizing your profit and minimizing your return. Because think about this, when you buy bigger properties, guess what it means? Bigger rehab, bigger headaches, more risk, less money potentially. Does that make sense? So you can take a big project and guess what? You might do 2 big projects a year or maybe 1 big project a year. What if you do 5 to 10 small deals? That's just going to maximize your return. So make sure less than 200,000. And that is just the best rule of thumb. The second thing is the rehab should not exceed 40,000, okay? That is just the sweet spot. Max tops 45,000, okay? So when you get these two numbers combined, that's just the formula for success. So we've done 29 rentals, right? Guess what? All of them are under 200,000. The rehabs, over 90% of the properties have been less than 40,000. That's how you can accumulate many rentals, grow fast, and minimize your exposure to risk. Okay. Now the question is, okay, that sounds good, but how do you do that? Very simple. Just don't go too far in your neighborhood. Okay. Whatever suburb you live or neighborhood you live, you already have an idea how much the properties are selling for. Let's say a 3-bedroom, 1 bath, or 3-bedroom, 2 bath are selling for, let's assume 200,000. Okay, that's the after repair value. So that's retail price. Guess what? If you want to be successful, you need 2 things. You need to pay $100,000 less than what the property appraises, and the rehab should be less than 40,000. That is the formula. I just want to keep it so simple, okay? So you don't need to worry about ARVs. You don't need to worry about like a very accurate rehab estimate, and you don't need to worry about how much you need to pay for the property. So I have simplified that formula into 2 steps. Again, you need to pay 100,000 less than the ARV. So if you want to strike a home run deal, if the property after the rehab has been done is worth 180, guess how much you need to pay for the property? 80,000. And guess what the rehab should be? No more than 40,000. That's the formula, friends. So again, I'm going to repeat that again. If the ARV is 200,000, you need to pay 100,000 less. Okay, meaning you pay 100,000, and the rehab should not exceed 40,000. Okay. Now, the next question may be, how can I estimate the rehab just by looking at pictures? Well, very, very simple. I'm going to give you another secret. You've got to know the square footage and multiply that by 2. That's going to give you a rough idea of how much it's going to cost to do the rehab. And this is, we're talking about a medium rehab. Now, what's a medium rehab? Any rehab, you're going to need to do two things. You're going to need to paint, and you're going to need to do the flooring. Okay, that's out of the box. Whenever you open up a property, paint and flooring. You may resand the flooring, you might put hardwood floor, you may do laminated, whatever you want to do. Now, the next question is, this is what differentiates between a light rehab and a medium rehab. Okay, forget about the gut rehab. We're not thinking about gut rehabs, and in fact, you should not do gut rehabs. Okay, so light rehab and medium rehab, what's the difference? The difference is if you are going to update the kitchen and bathroom. That is the main difference. If you see a property where you don't need to update the kitchen or the bathroom, that means that it's a light rehab. But if you need to change the cabinets, or if you need to change the vanity, the mirror, the lighting, that's right off the bat a medium rehab. And you want to stick to light to medium rehabs. So this formula works incredibly well. Okay, take the square footage. So the properties that are less than 200,000, guess what? They are going to be less than 17 or 1800 square feet. Okay, I'm gonna say that again. A 3-bedroom, 2-bath is going to be typically less than 1800 square feet. Therefore, if the property is 1800 square feet, multiply that times 2, 36,000. So with 36,000, you're gonna do 4 things: update the kitchen, the bathroom, paint and flooring. That's it. Okay. Now, if the property needs like a new HVAC system, a new roof, new windows, issues with foundation, new plumbing, new electric, the numbers are not going to work. And in fact, you don't want to take on those projects. Okay. You want to focus on projects that are light to medium. Why? Because you're an investor. You're not in the construction business. Think about this. If construction was where the money is, wouldn't you think that most handyman would be financially free? Exactly, right? But they're not, because the money is not on the rehab. The money is on investing, buying properties for the right price with very little rehab, because then you can move them quickly. Whatever the exit strategy that you want to take, either wholesale, flip, or buy and hold, okay? But the key, friends, again, 200,000 purchase price, rehab less than 40,000. Now, as a tip of advice, when you know the square footage, you always obviously multiply that times 2. So an 1,800 square feet property is going to be times 2, 36,000. You always need to add a cushion, okay? That cushion should be 5 to 10,000. There's always unexpected items that arise in the rehab, okay? You don't know what they are until you open up the property and start doing the work. So if the square footage is 1,800, then right off the bat, you should estimate 36 plus, let's say, 10,000. So the rehab is going to be 46,000 on that property. So I'm going to repeat the secrets again. How do you find a great deal? Take whatever ARV for any property is. So if a 3-bedroom, 2-bath rehab sells for 250, guess what? You need to pay no more than 150, and the rehab should be less than 40,000. That's it. That is the formula that is going to position yourself and your business at the level of the pros. That's how you can level the playing field, okay? Because guess what? The pros are not going to invest in like super expensive properties, and they're not going to invest in super distressed areas, right? They're going to invest in middle class neighborhoods. Okay, that's where you maximize your profit. So I'm going to give you some examples of properties, but I just want you to understand the numbers, okay? Because this is the secret that we discovered, and now without even looking at the calculator or the system or anything, all we want to know is the square footage of the property. We want to make sure that it's not a gut rehab, and we want to make sure that the purchase price, including the rehab, is going to be less than 200,000. Okay, so let me give an example. we recently bought a property in Mount Prospect, okay? Mount Prospect happens to be an A- neighborhood, okay? So I knew right off the bat that those properties are selling at least between 275 to 325, okay? 3 bedroom, 2 bath. 275, so I'm gonna put it on the board, okay? Those properties are selling for 275 to 325. So the average is they're selling for 300,000, okay? 300,000. So guess how much you need to pay for the property? Just knock off 100,000. So the most, very highest you need to pay for a property should be, if it's gonna price for 275, you need to pay 175, okay? So let me give you that example. So just to give you the low end, so the property will appraise for 275. So the most you can pay for that property is 175. That's it, 175. And the rehab should be no more than 40,000. So let me tell you the numbers. This property, I knew that it was somewhere in the 290 price range, 280, 290 price range. So we bought it for 160. As soon as I knew that the purchase price was 160, it was like, boom, I got the first number right. I'm gonna pay 100,000 less than what the property is gonna price for. Now, the second question mark is, what's the rehab? So what's the square footage? I need to know the square footage. So the square footage of the property is 1,700 square feet. So right off the bat, I knew the rehab was going to be at least 35,000, okay? And then when I saw the pictures of the inside of the property, it needed an update on the kitchen and the bath. So I knew that the rehab was going to be between 35 to, with the cushion of 5 to 10,000, about 40,000. So the rehab ended up being $37,000. And guess what? We just refinanced the property yesterday, and the appraisal came back at 284. Okay, so think about this. I'm gonna put it on the calculator. Okay, so that is just very simple math. Okay, um, so the property appraised for 284. Okay, so remember, you need to pay 100,000 less than that. So the most we needed to pay for the property was 184. We ended up paying 161. It was a steal, and the rehab was $37,000. Okay, so 161 we ended up paying, so about 20,000 below what I wanted to pay. Okay, plus the rehab was 37. Okay, so all in, let's say 200,000, and the property appraised for 284. So imagine we ended up with about 84,000 in equity. Okay, 84,000 in equity. So that is just an incredible deal. Let me see if I can show you the in my messages. Oh, okay. I think I might have them right here. So I want to show you something. Yeah, this is it. Okay, so this is the closing statement. Let me maximize that. Let me make it bigger. Okay, so open with preview. Cool, so we're gonna make it bigger. What is this? Oh, here. This is the one I want to open up. Perfect. Open with preview. So I want to show you the refi on this. Let me maximize. Okay, perfect. So this is what the numbers are. Somehow it's a little bit cut off. Let me make it a little bit smaller. Okay, for some reason the number is cut off. But you can see the bottom line is that we have a total loan amount of about 180,000 on the property. Okay, so we ended up with 20,000 stock in the property. So maybe I'm gonna show you these. Yeah, this is gonna be better. Okay, so this is the outstanding after we refinance the property, 180,000. So all in is 200,000. So that tells you we have stock in the property 20,000, interest rate 566, and then the principal, interest, tax, and insurance is 1560. That property is rented for 1950. So we're cash flowing $400 a month. Does that make sense? When you hit those numbers that I told you earlier, you buy the property for less than 200,000. The rehab is less than 40,000. Okay, then the numbers are going to work incredibly well. Okay, you don't need to worry about the back end refinance. Even we were able to cash out about $7,000 on this transaction. So now, all in, as I told you, 161 plus 37, about 200,000. So we got a loan for 180. That means that we have stock in the property 20,000. But imagine we're cash flowing 400 a month. So that means that think about the cash on cash return. I don't want to get you confused on that, but the cash on cash you compute is it's about 5,000 down payment. I mean 5,000 yearly cash flow divided by the down payment or whatever money is stuck in the property, which is 20,000. So that is, let me show you, 5,000 divided by 20,000 that is stuck in the property or your down payment, and that gives you a cash on cash return of 25%. Okay, technically you're going to go for properties that have a cash on cash over 15%. So this cash on cash is just amazing. So you don't need to worry about all these metrics like cash on cash, debt coverage ratio, all these complicated metrics, so long you stick to the secrets that I told you. Again, from what the ARV is, knock off 100,000, and the rehab shouldn't be more than 40,000. And then it's like a snowball effect. You're going to be able to do a successful flip and rental. You are going to be able to refinance on the back end if you decide to hold the property. You might be able to cash out. You are going to have positive cash flow of at least $300 per month. So in other words, when you rent it, the tenant is paying for everything for your property, and on top of it, you're cash flowing $300. Does that make sense? It's just what's called a home run deal. So what we did is we sort of reverse engineer all these numbers, right? Because when you talk to like lenders, they say, well, Hugo, it's not hitting the debt coverage ratio, okay, which is the net operating income divided by the principal and interest or the debt service. So this is sort of complicated, right? But that's what they go by, all the lenders. So you don't need to worry about all that. You don't need to think, work, or create anything so long you understand the two secrets that I gave you. From whatever the property will appraise for, knock off $100,000, and the rehab shouldn't be more than 40,000. Now, how do you estimate the rehab? You've got to know the square footage, multiply that by 2. So long, you all need to do is update the kitchen, the bathrooms, for sure, painting and flooring, right? No major plumbing work, electric work, mechanical or HVAC work, roof, windows, because that's going to throw off the numbers. And you always have to have a cushion of 5 to 10,000. Okay. Now, there's a question on the line. Would the bank let you refinance at 200,000, or were you required to keep 2K in? Yeah, no, they want you to have equity in the property. Okay. So we have 200,000 in. They had me have at least 20,000 stock in the property. So if you think about it, the loan amount is 180, and the property appraised for 284. So we have 100,000 equity. So what's that amount? So I'm going to tell you how much equity we have stuck in that property, or not stock, but how much equity we ended up in the property. So the property is worth 280. 284, but let's run the numbers. 280. We got a loan for 180. Okay, so there's $100,000. So 100,000 divided by 280, that's going to tell you how much equity we have in the property. 35% equity. Okay, so the banks want you to have between 25 to 35% equity on the back end. Okay, that's what, when you refinance, that's how much equity the banks want you to have. At least right off the bat, they want you to have 25% equity, which means if you buy it for 100 and you put in 50,000, the property better appraised for 200,000, right? So all in is 150, but you end up with 50,000 in equity, which is 25%. So banks, when you're going to refinance to pay off the hard money lender or private money lender, they always want you to have equity in the property. They're going to ask you for 25. In this case, we ended up with 35% equity on the property. But again, you don't need to worry about all these debt coverage ratios, all these 25 to 35% equity in the property. All you need to care about is pay 100,000 less than the ARV, and the rehab shouldn't be more than 40,000. That is the secret. That's how we've been able to exponentially grow. That's how we've been able to exponentially increase our monthly cash flow. Every transaction, we have 300 to 400 per month, okay? Per property, per door. Great question, okay? Are there any other questions on the line? Any other questions? So I just want to go back again and I'll show you what the numbers look like on the system. Let me just do a power search on that particular property. So if you want to know more about the numbers, right? So this is we're gonna take very quickly, sort of like the long route. First, yeah, this is the property. Okay, so let's see what ChicagoDealVault tells me about the property. Okay, so this is the property. So it's a 3-bedroom, 1-bath in Mount Prospect. So when you analyze a property, you need to know 3 numbers. You need to know the ARV, how much the property is going to sell for. You need to have an idea what the rehab is going to be, and you need to know how much you're going to pay for the property. Okay, so ChicagoDealVault is going to tell you everything, all 3 numbers. So you don't need to think, create, or work. So DealVault is telling me the property is worth between 280 to 281. Well, the property appraised for 284. Okay, so it's right in the ballpark. It says that the rehab is going to be between 18 to 27. Well, unexpected things happen. It came out to be, as I told you, you always need to be very conservative and add a 5 to 10,000 cushion. The rehab was 37,000, right? And DealVault tells me that if I'm going to do a flip, I shouldn't pay more than 165. Even if you're going to do a rental, which is the most forgiving offer, 192, you always need to aim for the flip max allowed offer, which is 165. In case you change your mind, then you can flip the property, so long you pay the right price. So DealVault is telling me I should pay no more than 165. We ended up paying 161 for the property. Does that make sense? So even without logging into ChicagoDealVault, all I needed to know for this particular property is how much is the retail price for a 3-bedroom, 2-bath in Mount Prospect. Okay, it's between 275 to 325. Good enough. I'm going to be very conservative. I'm going to take the 275. Therefore, the most I should pay for the property is 175. Does that make sense? And guess what? Doing all the math, all the numbers, because these max allowed offers, there's a formula behind that, right? I can tell you what the formula is. I can explain the formula, but it's just too much information, right? So I'm going to quickly tell you what that is in case you're curious. So you're going to take for the flip offer, you're going to take the ARV, you're going to multiply that times 70%, and you're going to subtract the rehab. You see what I mean? It's not so easy. And then you might wonder, why do I need to multiply the ARV times 70? 20% is going to be your net profit on the flip. In other words, you shouldn't do a flip unless you're going to make 20% return. So if you sell it for 200,000, you need to make at least 40,000. If you're not making that kind of money, you shouldn't even do the flip. The other 10% is for Carrying costs, holding expenses, like your interest, your taxes, insurance, utilities. Um, that's what the other 10%. That is why you multiply that times 70. But forget about the formula, right? We do that for you, but you don't even need to look at these numbers if you listen to the secret that I gave you. And I'm gonna put it on the chat, okay? So pay 100K less than ARV. That is secret number one. And secret number two is rehab should be less than, I'm gonna make it 45,000, okay? And stick to properties below 200K, okay? Guess what? Our first property in Glenview was over 200,000. So the rehab was over 60,000. Um, we couldn't sell it. We couldn't sell the property. And then up until now, that property does not cash flow. Does that make sense? When you don't know your numbers, when you overpay, when you overdo the rehab, the whole thing collapses. So that's what I wanted to give you today. It's a very simple but extremely powerful formula that you don't even need a calculator, okay? Are there any questions on the line? Oh, what are the taxes on that property? You know, Mark, great question. I'm glad you asked that. The taxes are maybe 5 or 6,000. I'm gonna click on the owner loan tab. Yeah, it's 5,400, okay? But I'm glad you brought that up. Thank you, Mark, because guess what? The formula, everything that I tell you works over 95% of the time. But guess what? The other 5% can be broken by taxes because guess what? There are some neighborhoods, some areas like somewhere in the southwest suburbs where taxes are, whoa, super expensive. Like for a 3-bedroom, for this kind of property, you're gonna pay 11, 12,000. So that's a deal breaker on the numbers, especially if you are going to buy and hold the property. It's gonna kill your cash flow. So the 5% possibility that this formula may not work is if the taxes are over 10,000. Okay, so I'm gonna make that my third rule. Taxes should be less than 10,000, okay? Thank you, Mark, for bringing that up, okay? So again, less than 200,000, you've got to pay 100,000 less than the ARV. Rehab should be less than 40,000, 40, 45, give and take, and taxes should not be greater than 10,000 because that's going to just wipe out your cash flow. Super important. I'm glad. Flossmore, perfect. Thank you, Mark. I was just not thinking Southwest Flossmore. So in fact, if we were to analyze Flossmore, guess what? First of all, the houses there are like a shoebox. They're super big. Square footage is over 2,000. So imagine your rehab is going to go over 50,000, right? And not only that, your taxes are over 10,000. Therefore, property sit on the market for at least 4 to 6 months in Flossmore. Why? Taxes are a deal breaker. Very simple. So I want to make sure that all of you understand these because behind every single number that you need to understand, there's a lot of information, right? But you don't need to break your head. So let's just quickly go over one example, right? So there's a question. How can I get the calculating software? Oh, okay. Thank you for asking, Kathy. We're going to give it to you for free tonight. Okay, this software computes everything for you. It gives you off-market deals like probates, pre-foreclosures, upcoming auctions, gives you access to the MLS. It gives you all the areas analyzed, cash buyers, private money lenders, the whole 9 yards. You're going to get it for free tonight for 30 days, okay? How long do you have to own the property before you are able to refinance? Great question, Ralph. So this is the trick. Now, you see, when you buy the property, we're buying distressed property. So we're using asset-based lenders, so Harmony lenders and private money lenders. Why? Because they focus on the property itself, on the asset, on the house, right? They don't focus on you so much, your tax returns. No, if you get a great deal, they're going to give you the money not only for the purchase of the price up to 85% of the property value, but also 100% of the rehab, which is awesome. So when you use asset-based lenders, and then when it comes time to refinance, meaning once you rented the property, you're going to need to pay them off, right? So you're going to need to use conventional lenders like the big banks, Chase, Homebridge, Bank of America, and so forth. They're going to be looking for a seasoning period of about 6 months, right? Well, guess what? This is something new in the last 6 months. Harmony lenders figure out that they're losing a big piece of the pie when the conventional lender pays them off and boom, they're out of the equation. They're not collecting any interest from you. So they got pretty smart. And now Harmony lenders are creating programs that they can turn your fix and flip loan into a rental loan, meaning a long-term low interest rate. So the example of this refi that I show you right here, well, this is the closing statement from yesterday, but the other image was showing you the interest rate. So now Harmony lenders, the one that we use, put the loan into a long-term low interest rate, five and a quarter, no, 5.6, 5 3/4, and long-term 30-year amortization. Okay, which is awesome because they don't require any seasoning, which is great. Now there's a loophole in the system. When you get a loan for the rehab and the purchase price combined, you don't need that seasoning period. But if you split, you know, the rehab and the loan amount in the HUD, they're going to require that seasoning period. Okay, so that's just a tip of advice. But great question. Are there any other questions on the line? So the seasoning period is about 6 months, but if you use the same Harmony lender to refinance, 0. You don't need to wait anything. Thank you, Mike, for your comments. So again, I just want to quickly summarize. So in fact, if you have a property, there's another question. How many mortgages one can get from banks while flipping over and over? Okay, great questions. When you flip, guess what? You are selling the property, right? So you are paying off the mortgage. So you can do as many flips as you want, and you're capitalizing yourself, meaning you're collecting big paychecks, right? So if you're flipping, that's not a concern. You can get 2, 3, 4, 5, 6 loans, especially if you're using asset-based lenders, because they care about you having a lot of equity on the property. They're going to give you the loan. It doesn't matter, but you do need to have equity, because when you have equity, like what I show you on this deal, you're going to cash flow. So they want to make sure that you meet all these ratios, like the debt coverage ratio. And that ratio is met when you hit the numbers that I told you. Pay 100,000 less than what the property is going to sell for, and don't go over 40, 45,000 on the rehab. And then all the numbers that all the lenders want are going to come right there, okay? How do you get a mortgage without having a job? Great question. I got laid off 2 years ago. I don't have a job. I don't have a W-2 or 1099. How? And that was the third piece of the equation that I showed you on the board. The great key players in the real estate arena, they have a great deal, they understand basic analysis, and they have funding. They have funding because they have a great deal. So the question is, you can get funding for your properties even if you don't have a job, because guess what? Harmony lenders and private money lenders don't care whether you have income. They care whether you have a great deal, because guess what? The property is going to be the collateral. If you, for whatever reason, default, guess what? The money is given to your entity so they can foreclose on the entity in as little as 6 months or less, right? So they can take over the property and they have a lot of equity on the property. So if you don't have a job, it's not a big deal, so long you have a great deal, like the formula that I gave you. Now, do you purchase properties under your name or best to create an LLC? Absolutely under your entity or S Corp. We use an S Corp. You can also use an LLC. Super important. There are 3 benefits by purchasing properties under your entity. Number 1, asset protection. If somebody falls and sues you, they cannot tap into your personal assets. The liability remains in the property itself. You may lose the building, but they're not going to tap into your home, into your personal assets. Does that make sense? Second benefit, asset taxes. The best tax benefit when you buy properties under your entity is depreciation, which means, and this is how the rich get richer, if they make $100,000, they get to keep that much. Why? Because they leverage from taxes. In this case, depreciation. Depreciation helps you offset all your expenses. You're going to do a lot of write-offs. Therefore, you are going to keep most of the money that you make in real estate when you buy properties under your entity. And the third benefit of buying properties under your entity is funding. Hard money lenders and private money lenders want to lend money to your entity, not to your name. And you know why? Because if you default on the payment, if it's under your name, the foreclosure process can take up to 2 years or more. But if it's under your entity, they can foreclose on your entity in as little as 6 months, okay? That's the big reason why hard money lenders and private money lenders want to lend under your entity, because should you not pay and should they need to foreclose on your property, they want to take over your property in less than 6 months. That is the reason. That is why they don't want to lend money under your name. It's too risky, okay? Great question. Another one is, do you have to have a lot of capital to do hard money loan? Okay, if you're going to become a lender, private money lender, you don't need to have a lot of money. In fact, most private money lenders are leveraging from their pension plans, 401ks, retirement plans, so they can utilize that money to lend to investors like you and I for a about 12% interest rate. So it's a nice return for them, right? And their money is secure because they're going to take a first position lien on the property. So the property is going to be the collateral. So great question. What about hard money lenders? So hard money lenders, so they're going to ask you, they want you to have skin on the game, okay? What I like about hard money lenders is that, and also private money lenders, so they're going to give you 100% of the rehab money. They're not going to give it to you up front. You need to do the work, and then you can take draws, okay? So they're going to partially give you the money as you complete the project, but they're going to want you to have at least 10 to 15% down payment, right, from all-in expenses, because they want you to have skin on the game. But if you use a private money lender, guess what? They can finance 100% of the transaction, so you can put zero money down. That is the big difference between hard money lenders and private money lenders. Private money lenders are individuals, and it's relationship based. It's who you know, but they can give you the money for everything. We've used them in the past, and we put zero money down because they gave us 100% of the purchase price and 100% of the rehab money, and they gave it to us all up front. So it's like the best, right? Great questions, Harry. Are there any other questions on the line? So, friends, incredible questions. I just want to quickly summarize and make sure that you understand what it takes to join the ranks of the pros and be able to grow exponentially. So don't focus on doing one deal. I want to make sure that you prepare, you strategize to create a business to do 5 to 10 deals a year and increase your net worth by 1 million in the next 2 years. Does that make sense? That is my objective for you, and that is what we're here. So let me tell you what the pros have. They have a great deal, they understand basic analysis, and they have funding. But they have funding because they have a great deal. And just to summarize, what it means to have a great deal. Take the ARV, whatever the property is going to sell for once the rehab is done, knock off 100,000. You need to pay that amount, and the rehab shouldn't be more than 40,000, and taxes shouldn't be more than $10,000. And that makes it a great deal. And that, guess what? Also takes care of your analysis, because I can go over the analysis on how you compute the max allowed offer and so forth, but it doesn't matter. We're going to compute that for you, but you don't even need to know what that is by using the secrets that I gave you. Pay 100,000 less than the ARV, do no more than 40,000 in rehab, and taxes no more than 10,000. And guess what? All the metrics, all the numbers are going to work incredibly well. If you deviate from that formula, it's like you're putting Tabasco sauce in the chocolate chip cookie recipe. You're gonna jack it up. So please stick to that formula, not Tabasco sauce in the cookie recipe. Please stick to properties on the 200,000, pay less, 100,000 less, rehab no more than 45, taxes no more than 10,000, and you're going to be able to refinance. You're going to be able to cash flow on the property. You're going to be able to flip it. You're going to be able to wholesale the property. Pretty much, you're going to have a golden goose if you stick to what I just told you right now. And that's how you will increase, double your income and triple your net worth in the next 2 years. Okay? Are there any other questions on the line? So I want to make sure that all of you have access to DealVault. So Phil, can you send the instructions? The promo code is going to be secrets. Okay? That's the promo code, Phil. So they're going to get Chicago DealVault for free for the next 30 days.